Welcome to Hot Sectors with me, Punita Kumar Sinha. Here we take a 360-degree view of the sectors that have seen policy initiatives and analyze the challenges and investment opportunities that lie in them. Today we look at India's financial sector, which could see changes with announcements such as new bank licenses and PSU bank recapitalization. What does this mean for the sector and for investors? I'm joined by Bimal Jalan, former Governor of the Reserve Bank of India, and Ashwin Parekh of Ernst & Young to answer those questions. Mr. Jalan, great to have you with us today. Let me begin by asking you, India is capital constrained. What risk do you see for capital adequacy for the Indian banks, especially with the Basel III norms, and whether those can be met?
No, there is no constraint so far as capital adequacy is concerned. As you know, we are following absolutely the international standards in regard to capital adequacy, provisioning, free reserves and everything else.
But if you look at deposit growth, that's slower than loan growth. Won't that create competition for deposits and, create more constraints for capital?
No, it could. So far as the banks are concerned, when the economy is not doing too well and if there is credit demand is low, then obviously that has implications for the bank's profitability and, they are functioning and so on. And as you can see, some of them can be under pressure, profits may be lower, but this is part of the game as it were.
So what can the banks do to increase their deposit base? Because, investors are putting money in gold, real estate and many other instruments as well.
No, that's correct, in the sense that if you find the economy slowing down, if you find the rate of interest, if the expectations are that the rate of interest can be below the inflation rate, then obviously the funds would move into certain other sectors. That's true. Our banks are strong as of now. They are all keeping, our scheduled banks. I'm talking now about the scheduled banks. And I don't see any particular problem in the medium term, provided we do macroeconomic management of the type that is required.
So in this environment, should new bank licenses be issued?
Oh yes, absolutely. We have to increase the reach of the banking sector. At the moment, the reach of the banking sector in our rural areas, in the non-financial areas is very, very small, as you know. And so the more banking licenses, branches are open, and this is one of the priorities of the RBI, as you know, and the Governor of the RBI has made this the principal thing about rural banking being the cornerstone, that we must expand the banking system, the banking reach all across the country, and that's a very long way to go, but that is the main priority just now. So new banking licenses should provide that possibility.
Now, Mr. Jalan, when you were RBI governor, you were not keen to have business groups get bank licenses. But today, they are going to be included in the applications. What is your view on that?
If you see the whole banking license policy that the RBI has announced just now, it is an extremely, from the begin with, they are taking care to make sure that the conflict of interest is avoided between the business side and the banking side as far as possible, and that I hope will be done. And at the moment you would see there is a process, the whole process has to be gone through.
In most countries banks are protected under the too big to fail clause. So with business groups getting banking licenses, do you think this will be an indirect way to actually protect the business group if it isn't doing well?
There you are absolutely right. And opaqueness has to be avoided. There has to be complete transparency, and there has to be complete adherence to the rules, which is that there should be no conflict of interest between business interests, that if your business collapses, it's not as if that would affect the banking sector. Because the business houses would have put their money in, and up to a point, if they are, and the RBI would make sure that the size of the investment which a business house makes in the banking sector, or for asking for a bank or which is given a license, is not such as to be dependent on the success in their other segments.
Now, Mr. Jalan, are you concerned about asset quality of Indian banks? As you know, NPAs have been rising and the restructuring book is also rising.
Yes, of course. But that again is symptomatic of the decline that you are seeing in profitability and decline that you are seeing in our real economy and real demand. And hopefully this would be cyclical rather than structural. And if it is structural, then we have to, go to much more extensive process of doing things which doesn't create an NPA problem of a long-term kind. Then that would be, that would create a lot of problem. It can happen. It has happened in other countries, and I hope we will avoid it.
Now turning to the budget announcements for the financial sector, what is your view on how inflation-linked bonds are going to affect that?
Oh, that's a very, in the sense that inflation index bond, and this related, by the way, to the very large demand for gold, for example, imports. And that you have a rate of inflation which is relatively high compared with the bank interest rates. Then there is a problem. And you can see that in our economy. And therefore, the indexed rates are something which would give scope for our financial savings to increase, for people to have greater confidence that they would, in real terms, they would get a positive return rather than a negative return. So, and that would, and you mentioned about demand being shifting to real estate investments or other sectors investment and so on. I think it's a good move to have an index-linked rates so far as deposits are concerned at the moment. But this is not a move which can last over a period of time if inflation remains where it is. But if inflation comes down to say 4 or 5%, then the choices become much wider.
Mr. Jalan, as you well know, Indian banks have one of the highest net interest margins in the world. Do you see those coming down? These
are issues that there are very long-term issues, and we have to reduce the margins between our cost of deposits or cost to the banks of money and the cost that we charge our borrowers. So that part on that there can be no two opinions. The only thing is that at the moment we have the financial sector is relatively small. We are trying to expand it. The cost of expansion is higher than what you might say can be met with a lower margin. So it's a complicated issue, if I may say so. But we have to tackle it over a long period. If you take a 20-year horizon, I think we should be able to tackle it.
Do you see any risk for the banking sector long term?
Yes, of course. There are always risks. Of over-regulation. That over-regulation in the sense that if there is too much of paperwork involved, then obviously there is a risk. That people would be, much more prone to take sort of not to expand their lending to sectors which are more risky or to sectors which are higher cost. So yes, there is that issue, and so I don't think that we can be complacent as of now. What we can be complacent about, not complacent, but what we can be confident about is that whatever standards we are using would meet the best practices in the rest of the world.
Well, thank you for your time, Mr. Jalan. I have joining me Ashwin Parekh, National Leader of Global Financial Services at Ernst & Young, to talk about his views on the policy initiatives in the sector and how he thinks the landscape might change. Ashwin, thank you very much for joining us today. Now, you've been very close to the government and the policymakers in terms of the reforms that are needed for the banking sector. Now, given that intermediation is so important, what do you think is going to be the landscape of financial services going forward, given that NBFCs and banks are coexisting, and banks are beginning to do functions of NBFCs, and NBFCs are going to get into banking? So how do you see this playing out?
Yeah, this regulator and the regulators who succeeded after 1994, somehow or the other do not have, do not accept NBFCs as a major intermediation kind of body or sector. There are reasons. There are clearly reasons. There has been enough evidence, in the past. The money that gets into the NBFC may find its way into speculative businesses, i.e. real estate on one side or commodities and gold on the other. So, that's the regulator's concern from the financial stability point of view. But the fact remains that they have a role to play in the economy. And the regulator has to first accept that role and design the regulations or keep the regulations around that. Now, that's one important aspect which I thought somehow or the other does not get covered.
So you're saying that NBFCs are doing so well on their own, why bring them into the banking space? Because they might lose some of the efficiency that they have.
Yeah, the reason is what you've really done is you created an environment for them which forces them to become a bank. And what is the attraction? The chief lure is the cost of funds. You know, so I mean, if they are really dependent on public funds, so it's actually a paradox. I mean, the regulator says that there is a dependence on public fund, and it sees an issue with the stability. But on the other hand, we should have created, you know, more instruments for NBFCs to make their, you know, mobilization far more, you know, efficient and far more at a cost, at a structure at which, let's say, banking companies or banking sector mobilizes. So to that extent, to my mind, I think we failed. We failed to recognize that NBFCs have a role, and we should create proper conducive environment for them.
But we've seen, like, I mean, ICICI
yeah,
started off as an NBFC, has become a bank, very successful transition. So isn't that a good role model for most of the NBFCs to follow?
It is. That's a hope. Actually, it's an excellent model. I mean, organizations like HDFC, ICICI became excellent banks, you know, subsequently. So they were NBFCs at one point in time, or they were development financial institutions in some form. They transited, you know, into that. However, let's not forget, in order to do that, both the regulator and the government really made the path very conducive, very easy for them. Are we seeing such a, let's say, acceptance today? I don't think so. You know, what we did for the conglomerates in 92, 93, and which is a remarkable job to my mind. I'm not seeing that somehow there is a reluctance on the part of the regulator to make that way, you know, to really make it a conducive kind of a way for the NBFCs to migrate into that.
So we have obviously a whole host of people going to be applying for the bank licenses, business groups, NBFCs, other financial institutions, you know, other people who've got banking experience.
Sure.
So how do you see this playing out? How many licenses will be awarded? What will be the criteria? And who will be the winner?
Yeah, no, that's a very interesting point. You see, if we go back to our earlier discussion, you know, Punita, we said that there is a need for capital in the banking sector. Now, that has to be recognized. Does the government really, you know, is the government prepared to put in that kind of capital? Not really. I mean, we've seen that on account of economic growth in Basel III, this time around we needed much more capital, but the budget allocation is of the order of about 12,600 or 12,800 crores. We need much more than that, you know, to really sustain the economic growth. In which case the capital must be found. Now, where is this capital? Where is that capital? The capital is with the corporate organizations, with the business houses. A, they have deep pockets. B, they have been here for long. Reputation is one thing they are very particular about. They will really be able to. So, and governance is something, you know, I mean, they have demonstrated in the past. So, to that extent, the acceptance this time around and the new guidelines are now looking at that. The regulator must be commended for the new guidelines and the various filters that he has laid down. I mean, anybody who's looking at that sector, regulating that sector, will really expect, you know, a certain very high order of governance, which is coming out very clearly in the guidelines.
So, you know, you talk about capital, and as you know, India's savings have been declining, especially household savings to the financial sector.
Sure.
So, in this capital constrained environment, does India really, should they really be awarding new bank licenses? And again, going back to, you know, if looking at the rest of the world, there are very few countries where business houses are getting licenses for banks. So, why do we need to do this?
Well, actually, that's the whole point. You see, we've seen our existing banking structure. We've seen the existing banking companies. Now, they've gone to about 95,000, you know, odd markets through their ATM and through their branch presence, you know. Is that adequate? I mean, on one count, for example, even the Post Department, the Indian Post, has about 140,000 post offices. And then we are not talking about those locations where you have a population of 2,000 and 3,000, you know, just people living in those rural areas. So to that extent, I should say, the hope is, and that's the reason why this reform, you know, very clearly links inclusion, you know, to the license. And it says if you want license, you have to really go to those markets and start, you know, covering more of the economy.
But the existing banks can also go to tier 2 or 3, tier 3 cities, as you've said. So, do you think these new licenses will actually create more penetration in the rural areas?
Those who will get the licenses, Punita, have no choice but to do it. This time around, the regulator is equipped with the new amended Banking Regulation Act. He's going to look at all the promises that a person makes in his application. And I would say he better do it. He better do it because, I mean, last time we gave away the applications, I mean, the registration or the licenses, you know, in the hope that there will be some 5 things that the banks will do. Perhaps they may not have done all 5. They may have done just 3 or 4. Could the regulator go behind, you know, after them and really say, look, hey guys, you forgot on your promises or whatever? He couldn't do it. But now he's got adequate powers, and I would rather, and pray and hope that he actually does it.
So who do you think should not get the licenses? What kind of groups should not get licenses?
Yeah, so now this is something very interesting. The regulators introduced some 2 or 3 definitions, and I must say once again, very commendable. The way they have been described. You said anybody who's in speculative businesses, and further gone to explain what is speculative business. They said that anybody who's likely to gain or lose value, on account of the market volatility, is certainly a speculative business. So now, therefore, it's not too difficult to convert into some kind of a model. The regulator wants to know. He has every right to know who are the investors behind. I mean, the most important part about the investors is nobody who's either blacklisted, on account of various activities. I mean, in the outside of India, you blacklist, and the banking regulator blacklists on account of either bribes, terror, drugs, these things. The last thing we want is an investor behind, a bank. I mean, in the form of directly or indirectly to that extent, the regulator has to have the right to really look at the structures and look at the investors behind those structures. Clearly, I mean, there's no doubt about that. Now, the larger question is, how far will he go? He's already created 2 structures. He said, look, I want people to create an NOFHC, a non-operating financial holding company, under which all financial service activities will be housed in one box or several boxes, and the bank will be housed in another box, a separate box.
Right. So, one important point you mentioned is that you're going to have separate companies. But if one company in the business group itself isn't doing well, that will impact the business of the bank. The bank affects society, and as you know, banks are generally protected by the government. So will this become an indirect mechanism to actually protect a business group that's in trouble, that has a banking license? It
does, because in some form or the other, imagine, I mean, look, if I am a deposit holder of a particular business group which floats a bank, which is allowed to float a bank, and then suddenly that business has lost tremendous amount of value at the market, on account of any volatility. Its business is on account of any economic cyclical issues is under trouble, let's say. As a deposit holder, my first reaction is, let me go and pull out my money, I mean, and there will be a run on the bank perhaps, So, I mean, I would say that's one part, which is a good protection for the business house as well. He may not today accept or recognize that he's not really eligible to form a bank. But I suppose if the evidence is given to him, that he's not really in a position to form a bank, then I suppose that should really explain.
But even if the business group is in a position to form a bank today, but tomorrow its core business stops doing well, isn't there a risk that the banking business will protect the business group's other core businesses when they're not performing well?
No, I mean, that's a very important question. That's a very interesting question. See, under the new proposed Banking Regulation Act, the regulators sought those powers. So he's going to continuously look at not just the balance sheet of the bank or the NOFHC or the CIC above it. He's going to look at all the balance sheets of the group. He has the right to call for that, which means continuously he'll keep on monitoring. And that's the additional capacity the regulator will require now. Because even if, let's say, we float 5 companies, people talk about 10 licenses and 5 licenses. But look at, on a back-to-back, the amount of work the regulator will be required to do on a very regular basis if he has to make sure that there is financial stability. And that's one of the reasons why he's suggesting 40% ownership now and 15% after 10 years. So fully in the 10-year period, if nothing untoward happens. After that, in any case, the promoter is not influencing the bank too much, So
one other question. What else do you think is needed in terms of reforms in the sector, in financial services, not just banking, insurance and other areas of financial services?
Some of the other, I mean, inviting foreign capital into finance sector has been, between the 2 sets of stakeholders, not really something which looks like a little planned or an examined kind of. Each time we find different approaches and views, and in the process, we've never recognized that can be an important source. That's one. Second is we invite FII money. We do, I mean, certainly. The only thing is it's hot money. It comes in. If the valuation or if the multiples do not go properly, then it will go away as well. Sort of, there are other markets where there are, more attractive markets, and that capital will go away. We've never been able to create instruments in financial services to attract that capital, sort of, And that's the form of reform I would have, really looked at, I mean, quite clearly.
Well, thank you very much for your time, Ashwin.
Thank you very much, Punita.
Ashwin certainly appears to be concerned about whether there's sufficient capital in the banking sector or not. Now let's talk to Tanveer Gill to see what the rest of the market thinks about the sector. Tanveer, what is the market saying?
Yeah, well, the verdict is out, Punita, and clearly the tilt is towards private banks. If we just take a look at the stock price returns for 2012, private banks come on tops there. Even from a valuation perspective, most of the private banks from an FY14 price to book, which is the valuation matrix followed for the financial space, most of the private banks are trading at more than 2 times a price to book. Even for that matter, the likes of an Axis Bank or an HDFC Bank, the price to book valuations are 2 or 2.5 to 3 times. For the PSU lot, if you look at the valuations for a Punjab National Bank, a State Bank of India from a 1-year forward perspective, it's closer to 1 time or just a little over 1 time. But there is not expected to be much growth. The market is still not factoring in a turn in the asset quality cycle. But that brings me to my question for you, Punita. Given that there's already been so much return generated by private banks and some of the select NBFC names, how do you view the potential of the banking sector?
Well, Tanveer, let's look at loan to GDP of the banking sector in India, and that's very low compared to other countries. So I think that itself provides a very attractive landscape for the future of Indian banks, and it provides a secular growth story, which is why you are seeing a lot of investors investing in the banking sector. But of course, NIMs are also very high. The net interest margin of the Indian banks are very high, second only to Indonesia in Asia. And that also makes it attractive for new entrants to enter the Indian banking sector. And India loan growth right now is growing faster than deposit growth. So that means that banks have a challenge in attracting deposits. And in this environment, banks that have the best franchises and are able to grab deposits are going to be the ones that are going to be best positioned to grow without their NIMs being under huge pressure. Otherwise, I think NIMs could be coming down. Now, you pointed out that the private banks have done very well. And I'd like to, just mention that over 5 years, if you look at the performance of banks globally, Yes Bank, IndusInd Bank, and HDFC Bank featured in the best performing banks globally. So clearly, private sector banks in India have been one of the best performing sectors. Now, turning to PSUs are facing a lot more concern about asset quality, but the valuations are really attractive. So I think within PSUs, you can also find interesting opportunities at the moment because of the better valuations. And then if you turn to NBFCs, they are very interesting for investors because given the announcements we've seen in the reform side, they're very sector specific. So one way to invest in the power sector, for instance, would be to look at the companies like Power Finance and others that invest in that space, or lend to that space. But I think the long-term growth prospects are there, and M&A possibilities are also there. So as the sector consolidates, I think investors will continue to look at the sector. Well, that's my view. With that, we come to the end of this episode of Hot Sectors with me, Punita Kumar Sinha. Thank you so much for watching and have a great day.